Welcome to the tax pooling and the imputation credits regime. I'm going to go ahead and welcome today's moderator into the conversation, Kane Bell. Kane, your microphone's open. Good morning.
Hi, and welcome to today's sponsored webinar, Tax Pooling and Imputation Credits Regime, sponsored by Tax Management NZ and hosted by CPA Australia. My name is Kane Bell, and I am the Relationship Manager at CPA Australia. We have people joining us from all over the country for today's webinar, so I'd like to extend a warm welcome and thanks for joining us. It's now my pleasure to invite Kathleen Payne. Kathleen is the Director of Strategic Partnerships, Tax Management NZ. Kathleen, I'll hand it over to you.
Everybody, and thank you for joining us today. Thank you, Kane, for that lovely introduction. So today we are going to talk about tax pooling and the imputation credit account. There's some, we're going to go from a sort of a base level to a more difficult level as we progress through this. But bear with me, I will do some sort of case studies, practical examples, so that you can get the hang of what we're going to talk about here. Firstly, I just wanted to give you a little bit of an intro about Tax Management New Zealand. Very briefly, we're the industry pioneer. We were New Zealand's original tax pooling intermediary and started up when the legislation for tax pooling was created back in 2003, so nearly 20 years now. This year, we hit the largest ever amount of tax that we've held in the pool of over $10 billion, which was quite a significant milestone for us over this time period. And one of the things you may not know about us if you are familiar with the tax pools is that we're proud to invest 100% of our profits back into our, New Zealand effectively through our philanthropic partner, the Whakatupu Aotearoa Foundation. And they do impact investment and charitable work in that environment, which makes what we do very worthwhile. So let's move into tax pooling. Basically, I wanted to firstly talk about what are we going to achieve today, because I think you need to know that from the outset, and hopefully at the end when I bring this up again, you can tick the box and say, yes, we got there. So we're going to explain the purpose of an imputation credit account just to get everybody on the same page, because I think it's important that we all know the very basics. I know most of you will already be at that point. Secondly, we're going to talk about when do we recognise imputation credits on tax pooling transactions. And then lastly, understand how to apply the rules for imputation credits to the tax pooling transactions with examples of how we're going to do this in a case study at the end that I think will hopefully bring everything together for you. So let's start off with an imputation credit account and what it is. I know most of you will know this, but let's get everyone on the same page. Memorandum account has a 31st of March balance regardless of what your financial year end is. So 1st of April to 31 March, normally prepared when we prepare the IR4 at the end of the year, or we can prepare a separate IR4J. The purpose of it is to record tax that the company has paid on behalf of the shareholders, so that when they do pass out that income that's been earned in the company, tax paid income, to the shareholders, it's not double taxed in the shareholders' hands. So as we pay tax during the year, we're recording tax that's paid by the company. And then when we get to pay out that dividend, we're attaching imputation credits to the dividend on the dividend statement, so that when the shareholder returns that income in their own tax return, they get a credit against their tax liability for the tax that the company has already repaid. So, very much a very simple idea, and I guess in its conception, sometimes a bit harder to actually follow it all through, but hopefully today will help you deal with the tax pooling transactions on it. So we recognise tax credits and payments. So anytime we pay tax or have tax withheld, like resident withholding tax on interest or provisional tax payments, they get recorded against the company's ICA. And debits that get recorded in there are, of course, when we take money out of the imputation or the income tax part of the account, and that will be where we get a refund or where we pay that dividend. So those sort of transactions all happen with tax pooling transactions, and sometimes transactions that you obviously can't do with IRD. So if we think about it, you can't go and buy tax from IRD, so that's something unique to tax pooling, and therefore we need to know how we deal with those specific transactions within the ICA. And part of it comes down to just the timing. When can we actually recognise these tax credits or debits? And so that's what we're going to deal with today. So we'll look at the different product types that the pools all use. So firstly, there's depositing into the pool. Next, there are flexible arrangements or purchasing of audit tax. Then there is tax finance, and most of the pools have something that relates to this. They just call it different products names, but this is effectively what they're doing with the tax. And the last one is a tax sale or refund. So we're going to start on a very, very simple basis. What is depositing into the pool, and then how do we treat that from a tax ICA point of view? So firstly, depositing into the pool. What I mean by this, it's an on-time payment into the pool when the liability is at its due date. So in other words, when we come to a prof tax date, instead of paying IRD on that prof tax date, you can pay the funds into the pool. And in the same way that you'd pay that to IRD, you would hold those funds in the pool until you get to the end of year when you prepare the tax return, find out what your liability is, and then you transfer across to IRD the tax that's due at each of the dates that you've got on the pool, or that you need to move it to. But effectively, an on-time payment, same way you do with IRD, but with a lot of extra benefits when you pay it into the pool. When you work out that tax liability, it may mean that you have tax that's sitting at the wrong amounts at the wrong dates. If that was the case, you might swap between those two dates to minimise interest and get tax at the right amounts and right dates before you transfer it to IRD. If you've transferred tax to IRD and then you find out that you've got some excess, you have some optionality in what you do with that excess. You could sell it to another taxpayer in the pool and earn some interest, or you could have that tax refunded out. And we'll deal with those in terms of tax ICA entries a bit later. And the other option is that you can draw down the funds in the pool and use those as a line of credit. So now that we sort of all understand what depositing into a pool means, in its simplest form, paying us instead of IRD on the due dates, we'll look at the ICA implications of that. Basically, when you've paid it into the pool, you can recognise the ICA entry, the credit, on the date of deposit. So how does this look in practice? Well, effectively, if you've got a taxpayer with a March balance date, they might pay their P1 on the 28th of August, and at that point, they can recognise the amount in their ICA return. Now, practically, most of us don't recognise or keep a monthly balance of our ICAs unless we're running really close to the wire on it, when we might be. Most of us will do it when we actually get to file the tax return. So while we say you can recognise it now, in practical aspects, we normally get to the end of the year, go through the tax pooling report and look at all the deposits that have been made and record them into the ICA on the dates that they were actually paid for, so those prof tax dates. So that one was really simple. What about when we're doing purchasing? I mentioned that there's a couple of ways of purchasing. One of those is flexible arrangements, the other is tax finance. Flexible arrangements are a type of arrangement that all the different pools have, where you have the flexibility to either make a lump sum payment, either now or at a future date. You might be paying it off in instalments. They might be an automatic payment, or it could be that you're just paying instalments as and when you have the cash. So there's lots of different reasons that these are flexible. It basically is saying, instead of paying tax to the IRD when they say you need to, you pay it when you can. So at the dates when you can, when your cash flow actually suits the dates. So let's have a look at what this means in terms of the ICA entries. So I guess one of the things that we need to remember when we're doing a flexible arrangement is that with all purchases into a tax pool, you have an extra 75 days after their terminal tax to complete the purchase. That also means that that's a hard and fast deadline to pay and transfer that tax across to IRD, i.e. you have to have across by the 75th day. So that's a hard and fast rule that's legislated. This year you'll say, look, there was actually an extension, and you'll be right if you know about tax pooling. IRD actually gave people an extra time to pay because of COVID, but in general, that's the rule. So from an ICA point of view, we've got a few different dates that happen in this, but basically the standard rule is when the tax is purchased, imputation credits will arise on the provisional tax that you're transferring the tax to. However, you can't recognise them until the tax has been transferred from the pool to the taxpayer's IRD account. And that's simply because IRD don't have visibility of the tax at that point in time until the transfer has been done. So when you deposit, we actually have to notify as a pool IRD of the deposits that have been made and who's made them. But when you purchase, they don't have any idea of who's actually gone and purchased tax from one of those taxpayers that's deposited or from a funder in the pool until the transfer's been done to that taxpayer's IRD account. So that's why there's a timing issue with it. Let's look at an example of this. So you've got a taxpayer who tax due on the 28th of August. They underpaid it by $50,000. So you as their advisor do the smart thing and tell them, why don't you go to a tax pool and buy that tax? So they do, and they decide that they're going to pay $30,000 of that tax in February and $20,000, the remainder of it, in March. Neither of those dates are applicable in terms of when we recognise the ICA entry or the credit for that tax that we've now purchased. It does arise, however, when that tax is transferred to IRD. So normally most pools will transfer that tax at a later date. And so that's when, at the point that you can now say, right, I can put that entry into my ICA return, but I will actually backdate it and put it at the 28th of August, which is a date that I'm transferring that tax to in my IRD account. So it's not too tricky on this one. We can kind of get there. We just need to read the reports that the tax pool has to make sure that we're looking at the transfer date and saying, right now I can do it. Often that date might be soon after the date of the tax that was due, but it could be sometime in the future, as you can see here. And so when you're looking at filing that ICA return, you wouldn't want to file it until its due date of 31 March 2022 for the 21 return, say, because you want to capture all those entries in there. And speaking of that, it's like, how do we do this in practice? What's the practical way that people do it? How do I tell IRD about this entry? Well, firstly, if you haven't filed your ICA account, it's really simple. You just include it. But if you've already filed your ICA, what do? In practical terms, what we see happening out in practice is people will just include it in their current ICA period. Technically, IRD would prefer that you actually just did a secure email to them and said to them, hey, we've got a tax pooling transaction. That means we're amending the closing balance of the prior year return if that was the case. And so that is what they prefer. It's not what we see happening in practice, and we haven't seen IRD actually pull people up on that for a while. So at this point, I guess they sort of think it's acceptable, but we know their technical position that we will tell you will be doing a secure mail. Do you file an amended return? No, not if it's a credit that you're putting in there and it's increasing a credit balance. You don't need to file an amended return, and IRD would prefer that you didn't. We'll talk about amended returns a little bit further down the track. So we would recognise that, as I said, back at that 28th of July. So now let's have a look at tax finance. So another way of purchasing, slightly different, meets a different customer's need. This is where somebody would like real certainty about what they're going to pay out and when they're going to pay it. I kind of liken the flexible arrangement to like a floating mortgage, if you like. The rate's normally floating. I've got flexibility of when I can pay it. I've got options to, if I don't need it all, I can delete it in the system. Whereas when I'm doing a tax finance, it's all about certainty. It's a bit like a fixed term loan, I guess, in that the rate is fixed, the maturity date is fixed, and normally I've got reasonable certainty over the tax that I'm actually funding through the pool. So what happens typically with this is that someone will pay a fee up front when they do the arrangement, and then they'll agree to pay the tax itself at a future maturity date or settlement date, if you like. They'll buy it for a particular tax date, as you normally would, but what they'll do is pay that fee up front. We'll put funds in the pool for that date, set them aside, and then when it comes to maturity date, the taxpayer will pay the actual tax, and then we'll transfer those funds across to IRD. So from an ICA point of view, basically there's no difference between what we were doing with those flexible arrangements and what we're doing with the tax finance. Just often we'll have a longer period to when we can recognise them, because quite often people who tax finance often go to that last, almost 75th day, the last payment date before that date, to take full advantage of financing rates, or to just basically defer the payment out of that cash until the last possible date. And we saw a lot of that during COVID when people were just hanging on to their cash and saying, look, I need as long as possible. What they like about this one is that they can hold it and have that certainty of the rate, fixing that in. So where it's financed, imputation credits will arise though on the date that they are transferring it to, so that provisional tax date that they're normally buying it for. And again, they have to wait until the transfer is done by the pool to the taxpayer's IRD account before they can recognise it. So if you can see it in the MyIR, the transfer's been done. If you can't see it, it might be pending, and that means you can probably still recognise it, but IRD can't quite see it yet. So that's an indicator for you. Again, I like to sort of show this in practice because it makes it more real. Let's look at the dates, because this is where people get confused. If we've got a 15th of January tax date, and they want to defer, in this case, $125,000 to the 17th of April of the following year. So they've agreed that date with us. Basically, when we say agree, they just set up an arrangement. When they set up that arrangement, we say, okay, we've calculated the interest to that date between the 15th of January and the 17th of April, because that's the period that you're financing this tax over, and they will pay a fee. When they pay that fee, obviously that is interest, it is not tax, and none of that will hit the ICA account. What we're waiting for is when that tax is paid and then transferred to the IRD. So on the 17th of April, that maturity date, we have the settlement of the core tax of $125,000. At that point, we still can't recognise the ICA entry, but shortly thereafter, there will be a transfer from the pool to the taxpayer's IRD account, and now we can put that into the ICA itself. And we'll put it into the 2021, say this is 2021 that we're talking about for 15th of January, we'll put it into that ICA because that tax is dated on the 15th of January 21. As I said, some will practically put it into the 2022 ICA, or even the 23 if you're looking at that settlement date. But IRD is saying really it belongs back in the 31st of March 21 ICA. So most of this is pretty straightforward. As you can see, if we do a quick recap, we've got the deposit where you're just paying it instead of paying IRD, you're paying it on the provisional tax date, recognise it, the credit at the date that you've made that payment on that prof tax date. When you're doing purchasing, whether it be a flexible arrangement or a tax finance arrangement, which is more fixed in its nature, then you will actually be recognising it at the date that you're transferring the tax to, so the provisional tax date, but you won't be recognising it until the transfer has been done to the taxpayer's IRD account. So having got the hang of the credits, I now want to lead you down the credit path, so the debit path. And this is where things get probably slightly more tricky. So hang in there, I will give you a case study that will make it feel a little bit more understandable. So we talked at the very beginning, I mentioned there's a couple of ways of getting your funds out of the tax pool. One of those is to have it refunded, the other way is to sell it. And when you're selling it to another party that has put money, that needs money from the tax pool, so they need to make a purchase. When we sell it, that taxpayer has the ability to get interest from the tax pool at the tax pool sale interest rates. So that's over and above what IRD would give them. And of course, at the moment, IRD is not giving them anything because the overpayment rate is 0%. It's unfortunate as that is in the current market. On the other hand, if they're doing a tax refund, then that's normally really quick access to that tax. They could say, and particularly in COVID, we saw a lot of this happening where people said, I need the cash out now. I want to have that tax in my hands because I need it in the business. Provided they've done AML, then they can have that tax out within 3 to 5 days. And actually during COVID, we had it out within a day or two. We were really onto it because we knew that people needed it right then and there. And so we sort of talked to IRD and said, come on, we need to get this money out to their account really quickly. Normal days, it's normally 3 to 5. So what does that mean from an ICA perspective? No different to taking money out of IRD account and having it refunded back to the taxpayer. But there's timing rules. So what does it mean from a tax pooling perspective? It gets a little complicated. We've got an ABC rule. It's theoretically, in other words, I could have done an ABA, but we'll go with ABC. What it says is, instead of going back to the original ICA period in which that credit arose, which could be 2 or 3 years ago if you're getting a refund from tax that's been sitting in the pool for a while, you actually just go back to the last day of your previous ICA year. So if we're doing a refund or a sale as of today, our previous ICA year was the 31st of March 2022. So you go back to the balance that you had at the end of that ICA period, and you say, is there sufficient credit at that date to cover the debit for the refund or sale amount of tax that is coming out of the pool? If there is, great, you can stop there, everything's okay. If there's not, absorb all you can in terms of a credit balance at that date and come forward into your ICA. You'll have to do a mock ICA, obviously an interim one, just not filing, but just for your own purposes, and work out what credits have been put into that ICA, what movements have happened, not just credits, but debits. What does your ICA position look like at the date of the sale or refund? If there have been further amounts that have resulted in net credit at that date, then great, you can absorb the debit, the remaining debit, at that date. What if there's not enough at that date? This is when we run into that horrible territory of creating a debit balance, and that debit balance gets created back at the 31st of March of the previous year, so that 31st of March 22 if we're doing that now. Now, obviously, we don't want to create a debit balance, so we need to be really careful. And the key message with a lot of what I'm talking about today is to be aware of the timing, go back to the rules, and plan out your ICA so that you don't end up in a debit position. If you are in that unfortunate case of a debit position, then you do need to file a revised ICA. See, I told you it was coming. So that ICA has to be filed within 2 months of the date of the refund or transfer. So this is obviously then going to incur further income tax and imputation penalty tax, and neither of those can be helped by tax pooling. Only reassessments can, which I'll come to in a minute, reassessed ICAs. But so if those amounts are due, it's a really unfortunate position to be in. So plan, plan, plan. So let's look at how that looks in practice, because for me, going through and actually putting real numbers into this and looking at how this would work was the way that I got to understand it, and now it's sort of second nature, but that's because I deal with it all the time. You might only deal with it occasionally, so let's see if we can get you across the line. So if we took a case where on the 15th of January, we'll call it 2021, we had excess tax of 60K, and the taxpayer said, I don't need that for my 2022 year, I'll just get it sold, sell it to another taxpayer, earn some interest. So they sold it on the 8th of May. What we know in terms of fact here is that their position at the 31st of March 2021 was $20,000 credit. So that's a good place to start, I guess. And on the 7th of May, they paid their P3, so that put a $30,000 credit deposit in. So let's work our way through the ABC rules. So starting with A, we says go to the last day of the previous ICA year and absorb any credit that's sitting there up to the balance that exists. In this particular case, we've got 60,000 debit that we're wanting to put through the ICA. We've only got a 20,000 balance at that date, so we'll absorb that full 20,000. It'll become a zero balance. But we've still got 40,000 imputation debit to record. So we'll move forward on part B, go to the date of the sale or refund, and see if you can use up any credit that exists at that date. At that date, we've got that 30,000 deposit, so we absorb all of that, but unfortunately, we've still got $10,000 left in terms of the tax that needs to be absorbed in the ICA. So we will now go back to the 31st of March of the previous year per part C, and that being 31st of March 21, we'd already zeroed it out, so that creates that debit balance of $10,000. And that will, of course, then come with a 10% imputation penalty tax of $1,000. So not a great position to be in. And as I say, if I was looking at this and advising a client and I plotted all this out and did my ICA, I'd be going, okay, I think you should only sell $50,000 and we'll wait for that other 10K until we've got more credits to absorb it. So having led you through the trickier parts of this, I also want to talk about some other imputation debits. Because when we're looking at that, if you transfer tax out to another taxpayer, to another tax type, we know from an ICA point of view, you're taking it out of that income tax bucket and you're moving it out of your ICA account. There are other ICA debit considerations, and what I've got on this slide are some different things that we get asked quite often, particularly when it comes to shareholder continuity breaches or paying out of a dividend, that we could ask, can tax pooling help with that? Or I've got this tax pooling transaction, what impact will that have in this situation? So I think it's really important to go through these particular parts of tax pooling and the impact on the ICA account, because they are common questions and you might only come across them once every now and again, but we see them a lot, and so we feel that it's something that we need to communicate out there. If we look at tax swaps, and I don't know if you recall earlier, but I did mention that if you deposit tax into the pool, you're holding it in there. You may have maybe deposited too much at one date and not enough at another date. So you'll swap between those two dates. And what that does is contain the interest, because you're not purchasing from today back to the date that you needed the tax. You're actually just doing a swap and purchasing between a shorter time period. So that reduces the interest cost. And at the same time, you're selling some tax. So if you can get some interest on that, it's reducing the overall cost of putting the tax in the right place. If you think about a tax, a swap, it is what I just said. It's a sale and a purchase. So there's nothing tricky about this. Split it into its two parts. Treat the purchase side of it as you would the flexible payment arrangement or the finance arrangement. Recognise it at the date that you are applying that tax to, so the provisional tax date, but not until the swap's been completed and the transfers have been done. From the sale point of view, you're going to follow that sale refund process that I just talked about, which was the ABC rule. So go back to the previous ICA return period, see if you can absorb the sale portion of the swap at that date. If you can't, go to the date of sale, see if you can absorb it there, and hopefully you don't get to part C where you go back and create that debit balance. So nothing too complicated, just remember split it into its two different parts and you'll be fine. When we talk about groups of companies, there are special rules in the tax pooling regime that allow groups of companies to treat deposits slightly differently to other taxpayers. And basically it's saying that if you've got a deposit in the pool for one member of a group of companies, then you can use those other members of that group of companies can retain what we call own status. Now, for those of you who are not familiar with that term, when you make a deposit, you've basically got own funds. You're the first one who's put those funds in the pool. So you've made the deposit, you've got own funds. Own funds don't have the timing restriction that purchased funds do. If you remember when I talked about purchased funds, I said that they had the 75-day time limit, and that applies to both whether you're paying them on either of the two different ways, whether you're paying them on that finance or you're paying them on a flexible basis. You've got a time limit of 75 days. When we're talking about a deposit with a group of companies and they've got those own funds deposited, the rest of the members, if they get those own funds transferred to them, can treat them as own funds in their own hands. Now, of course, with any of these rules, there's always a but or an if or an exception. Basically, what it says is if company A deposits funds and company B, who's in the same group of companies, and when I'm talking group of companies, I'm not talking imputation groups, I'm not talking consolidated groups, I'm talking about a group of companies under IC3 where there's 66% or greater shareholding, so greater than 66% common shareholding. So if you've got that group of companies, company A makes a deposit, company B has tax liability, company A transfers tax to company B treats that as own funds. Company A, its debit, when it has that transfer out to company B, is done at the time of the transfer, and company B's ICA, the credit is at the date that they have got it the deposit in, and they get to treat it as own funds, no time limit. Now the rule is that company B must have been a member of the group of companies at the time company A made the deposit. So in other words, you can't, if you have a new company that joins the group of companies, and it joined it after the deposit was made, or it was only created, became incorporated after the deposit was made, that rule won't apply. If you transfer from company A to company B, in that case, it'll be a sale from company A to company B, purchased funds in the hands of company B, so they'll treat it as a, will recognise it in the ICA when it's been transferred to them, and company A won't get a debit at the date of transfer. They will have the full sale record of the ABC rules. So you can see why I'm mentioning this. There's a difference in timing for groups of companies when it comes to those ICA entries when you've got transfers between them. And I think it's really useful because quite often what we see with groups of companies is that sometimes the nominated party or any member of the group actually might make a deposit on behalf of the whole group, because that saves them on admin. And they'll make that deposit, and they'll basically, once they do the tax returns for the entire group, they'll then do the transfers out to each of the different members of that group at the end of the year when they've done those tax returns. And so that's when these rules come into play. If you're transferring between those groups of companies and they're members of the group at the time the deposits were made, you don't have that time limitation. As soon as you transfer, in the same way that it is between, if you transfer between a company, a trust, or husband and wife, associated rules don't work for tax pooling. You have to transfer them within the 75th day. So for an ICA purpose, that just changes how you record it in the ICA as purchase funds or these group funds. Transfers to other tax types. One of the advantages or benefits, I guess, of holding funds in the pool is that if they've been deposited funds, they could be used for other tax types. So normally with tax pooling, it applies to income tax. It only applies, you can only use tax pooling for other tax types normally when you have a reassessment of that tax, so GST for instance, and there's an increased amount of tax and you buy that. Obviously, if you're doing that for other tax types, it all sits outside of the ICA. But if you've got a deposit in the pool and you've recognised the credit into the ICA at the time of deposit, and then you go and transfer that tax out to GST or FBT, which you can do with own funds, you can't do with purchase funds, you would get a debit to the ICA at the date of transfer. So again, nothing tricky in there, much like you do and when you're doing it in your IRD account. You just need to remember the rules. The one that I tend to get the most questions on, as do the other tax pooling specialists at TMNZ, is shareholder continuity breaches or dividend payments. So shareholder continuity breach, we know with an ICA that if it's a significant change of shareholding, that there is a debit to the ICA that basically clears out whatever credit balance you've got at that point in time. When that happens, a lot of people will say, oh, that didn't happen, it wasn't planned that way. My client went and did it, and now I'm trying to fix it up. What can I do in terms of, if I've got a purchase, for instance, what can I do with that so it doesn't get caught as being in prior to the date of a shareholder continuity breach? And you can actually, if you think about a purchase of tax, we can only recognise the imputation credit in the account when it's transferred to IRD and then on the date that it's been transferred to. So you can choose not to transfer it at the date you originally purchased it for, but defer that transfer to a date after the shareholder continuity breach. And I can hear you already going, but what about late payment penalties and use of money interest? And that is a trade-off, and that is a commercial decision that you have to make with the shareholders, directors of the companies, to make sure that they are comfortable with doing this. And if they are, then fine. There's nothing in the tax legislation around tax pooling that prevents you from doing that. You just need to be aware of the consequences. Is it better for them to preserve that imputation credit and have use of money interest and late payment penalties, or should you have a good record with IRD? So that is something that comes back to a commercial decision, not something that we are going to advise you on in terms of what's best for you, because that's a taxpayer decision. But there is the flexibility to do that. With own funds, you've already recognised the credit on the deposit date, So you can't change what date, even if you do a transfer to a later date from that deposit, because you've already recognised the credit at the date of deposit, there is no further ICA entry when you do the transfer at a different date. So that will never help you with a shareholder continuity breach. The other thing that we commonly, as part of shareholder continuity plan breaches, is that you will possibly pay out a dividend, right? Because you normally want to clear out that ICA account of all of the credits in there so that you have a nil balance on the date of the shareholder breach, and that means that there's no debit, or if there is a debit, it's a zero. So when we get asked about this, it's often, I want to pay a dividend, but I don't have sufficient ICs. How can I still buy my tax and pay my dividend and be compliant with IRD? And the way that you can do that is by purchasing tax back in that ICA period so that you end up with your credit balance, but you obviously will have a longer settlement date that's after that dividend date. That's okay. You can actually rely on that imputation entry that will ultimately be put into that account at that time, provided you have real certainty that your taxpayer is actually going to pay that arrangement on that date. So I think that's the caveat there, is to be really mindful of who your client is and how compliant they are, what their cash flow position is like, any risk that that might change. So we often, have that question of, I guess, coming into play, I've got a debit balance in my ICA. How can I fix it? Can I use tax pooling and just go and buy some tax, dump it into that ICA period, and all will be right with the world? You have to exercise some caution in this place, because effectively IRD back in 2011 went, hang on a minute, I can see that tax pooling's been used for purposes of which it wasn't designed to be used. People are going and buying in tax for previous years, old years, and fixing up debit positions when they should have actually been compliant with the legislation in the first place and not got into that position. So IRD then put in a couple of legislative points in there. They put in RP 17B, and within that they restricted what the tax period was and what tax you could put in. So they said, this is the maximum tax that you can buy, and these are the dates at which you can buy it. And effectively what it said was, if you've got a tax liability for the year, then by all means go and buy it early if you want to fix up a debit position, but you can't go back to a closed year. So in a closed year for tax pooling purposes is one where the 75th day has already passed. So if we think about it, take the 2021 year, the very last date on that was the 7th of April was the terminal tax date for the late balance dates. The 75 days after that was 21st of June 2022. So that date's now passed. The 2021 year is now closed. You can't use tax pooling for that year. If you come to me now and say, Kathleen, I want to come and buy some tax for the 2021 year, I'll say, I'm very sorry, you can't do that because legislation says no, that year's closed. If we're looking at a debit position, I'll be saying to you, do you have a tax liability for an open year, so the 2022-2023 year, that you can buy that tax early back at a date prior to the 31st of March of the year that's in debit, which would be a one of the open years. If you have, then buy it early, that's fine. But you can't buy more tax than what your liability is, because that's also what they've thought about. So there's two rules that come into play there. One says, the 17B says if you filed your tax return, then the maximum amount that you can transfer is the provisional or terminal tax liability. The other section that comes into play is RP 19B, which says if you haven't filed your return but you have an expected tax liability, then you can go and buy tax at whatever date you need to, but no earlier than the first day of the year, and then you can use that. If the benefit of doing that means that you correct a debit balance, then that's all good, but it can't be the main reason you're doing it. You're doing it to satisfy a tax liability. And if there's a TIB that they put out back in 2011, October 2011, and at that point they discussed it and said, if you're doing this for these purposes and you file a return after telling us that you hadn't filed a return, and then a month later you filed a return and tax liability is way down, we could go and revisit that position and say, hey, you purchased tax when you knew that actually it was going to be for a lot lower amount. So that's sort of the warnings they put in around that legislation. So the question is, can I legitimately go and buy tax to solve my debit position? And the answer is yes, provided you're buying for an open year and you can buy that tax at an earlier date. And it's not, it's for an expected liability based on the information you have now, or it's the actual liability based on the tax return that you have filed. Imputation penalty tax, I touched on that before. When you get a debit balance, you get imputation penalty tax. And when that first happens, it's not income tax, so you can't sort of go and buy it. But if you have it reassessed, then it's one of the tax types that's specifically included in the tax pooling provisions for reassessed tax that say you can go and use tax pooling to buy an imputation penalty tax, so a tax amount and the further income tax. So where that sort of comes into play is probably where you had a return, you have now had a reassessment of the ICA, so I'm talking about an ICA return, it's been reassessed because you've amended the position and that's put in a debit balance, and now you've got imputation penalty tax. Now you can come and buy that off us. So that's sort of where it fits into play. The other part that I've got on there is reporting, and you may be thinking, what link is there to reporting? Basically, I'm saying the reporting that you have out of your tax pool should assist you with doing your ICA entries. I guess the key message here is make sure you put in the right dates. Don't use your financial period, because remember we're using 1st of April to 31st of March. But if you're looking, that'll work, putting in those dates into your reporting for an ICA period where you're looking at your deposits. If you're looking at your purchasing transactions, then you want to know the date of transfer, and that could be well after the 31st of March. So you want to go 1st of April to today to pick up all the transactions that have a transfer date that's actually happened after the 31st of March, but which have an effective date, so the date they're going to be transferred to, that falls within the ICA period that you're looking at. So that's kind of a hint on that one. So I know that part was quite, complex. A lot of new ideas been introduced here for quite a few of you, but hopefully it answers some of your questions that we commonly get that tell you, what do I do from an imputation point of view with these different scenarios. What I'm going to do now is take you through an example that kind of brings most of this stuff together. And I really like this example because, one, it's a true example. It came from a client who said, I've got this position, can you give me advice on what the impact is on my ICA? And then we thought it was such a good example that we would use it for case studies going forward. So the question, you've got a client with a group of companies, so greater than 66% common shareholding, who have an ICA balance at 31 March, we'll call it 2021, of 528K. And that sits in a parent and some subs because we've got the group. Unfortunately, they had a shareholding breach on the 19th of April, so not long after they had that great balance of 528K, so it's quite obvious they would have lost that balance. During the year, they made deposits of tax for P1 and P2 for their current year, and then they prepared their 2021 tax return. When they prepared that return, it was quite obvious that they hadn't paid all the tax, so they proposed to use the deposits for P1 and P2 to swap back to their 2021 tax payments that were due. And once they'd done those swaps, they would then transfer that tax, because it'd now be sitting at the right dates, amongst the group, so the parent and its subsidiaries. So what they had was the deposits that were made post that shareholding breach date for the current year. And then they showed us what the swaps were that they needed. So they're going to take all of the current year P1 and transfer it back to satisfy the P1 and part of the P2 of the prior year. And they're going to take part of the P2 for the current year and swap that back to complete the payment of the P2 amount and finish off with the P3 amount. And when that was, as I said, when that swap was all sort of done, they would allocate it amongst the parent and its subsidiaries. So the total that they were swapping was going to be allocated out. And that all looked perfectly logical. And so the thing that we said, they said, well, what's the timing of each part of this transaction? Because we've got a swap. So we looked at how do you break that down. Remember I said we've got a swap, it gets broken down to the purchase part and the sale part. So let's have a look at how that pans out. As all good accountants, we would either put this into our accounting software or we do Excel. So in Excel, we reconstruct the position. What's our opening position? They had the opening balance of 528k. We know they lost it with the shareholding breach. And then they had the 2 deposits that came in for the current year, which meant at 2022, they had a credit balance of 347k. Great position to start off on. Now we'll look at the sale portion of the swap. If we think about our ABC rules, we'll go back to the 31st of March that we're talking about, and nearest one was 31st of March 2022. Have we got sufficient ICs at that date to cover the debit that's getting created by the sale portion? And the answer in this case is yes. We've got 347,000 of imputation credits at that date. Our debit's only 252,000, so we've got a credit still there of 94k. Now let's look at the purchase portions of that swap. And if we look at the timing of this, those deposits, if you can see, when they were made, they were recorded on the date of the deposit. The sale bit is following the ABC. So now we're going to follow the purchase bit. The purchase part was basically done in May 22, but it went back to those prior dates in the 2021 year. So if we can look at that, we can say, look, we've got further credits. That all looks fine. We didn't recognise them until the 29th of May when the transfers were done. They paid for it on the 23rd of May. So those are all the dates that we've been talking about. What is the effective date or date we're going to transfer them to? That's that August, say 2020 and 15 Jan 21. We paid for it on the 23rd of May, which we could ignore for ICA purposes. It was transferred to IRD on the 29th of May 22. Now we can recognise it. So I guess what this slide is showing is that we've actually basically gone through every sort of transaction, and those main transactions rather that we were talking about, purchase, deposit, sale. But there's something wrong with this picture, and I don't know if you guys have twigged to it yet. But if we look at reordering those effective dates or the prov tax dates that we're recording these transactions in, we might end up with a different scenario. So if we go back and restate these in the order of the dates that are here, so those purchases were actually made for the 2021 ICA. Those dates fell into the 2021 ICA period. So when we record them, if we reopen that, if we're saying, look, we're going to reopen it, and what would it look like? We restate it. It would have the opening balance plus those 2 purchases to give a revised closing balance at the end of 31st of March 21 of 713k. Still looking okay at this point, but we then had the shareholder continuity breach, and so we've lost it all. We've then got our 2 deposits, so we've ended up in a good position, but we've actually sacrificed those 2, that 180k, and I'm just talking about the payments portion. We've sacrificed that position back at that time. So we then have our swap coming in at the sale portion of it, because we've recognised our purchase portion. We still end up with 94k at the end of it. But it's not the position that we'd want to be in. We've sacrificed that 180k. So the question then is, what could we have done differently? And in this scenario, we said to the client, what did you decide to do? What was the client comfortable with? And the answer was, instead of doing their swaps back to P1, P2 and P3 of that prior year that would cause this issue, because they do pay out a lot of dividends, they decided that they would actually not do the swaps back at those dates. They would only do them at P3, which arose after the shareholder continuity breach, and preserve those imputation credits. They did that knowing that they would have use of money, interest and late payment penalties. They also did it knowing that the income that those shareholders, was responsible to was actually the prior shareholders. So, that's why there's a lot of, I guess, risk and governance issues that are brought up by this particular case scenario that you have to be mindful of when you're going to do this. And I think that the key message is plan it, work out your ICA, follow the rules, and then make sure that you understand exactly what's going to happen before you pitch this to your client, because you can change things if you want to, or you may decide that what you've decided is the right thing to do by this client and they agree, but you go in knowing what the end position is going to be. So having got to this point, it's time to go to the Q&As, but I just wanted to recap our objectives here, and hopefully you can say a tick that we've met them. So you understand the purpose of an ICA account to prevent double taxation. You now hopefully understand when to recognise the imputation credits for tax pooling transactions, and you've had some good case studies on how tax pooling transactions occur and planning those out so that you get the tax implications of those in the ICA sitting at the right dates. I'll throw it back to Kane.
Perfect. Thanks, Kathleen, and thank you so much for your presentation. So for anyone that would like to send through some questions, please just put them in the chat and we'll get through to answering those. So I do have a question here. So the first one is, if I purchase tax and then get some of it refunded later, do I just ignore this for ICA purposes?
Yeah, great question. So if you've purchased tax, people would say, well, it's never actually hit the ICA because we haven't done a transfer yet, and we're now doing a refund of it. IRG had a slightly different view on that. They're saying you still have to do the ABC rule for the refund part of it, but you would get a credit that recognises the purchase part at the date of refund. So it's like a notional credit that comes in to balance out the ICA. So yeah, they thought of that one and said, you know, you can't avoid it altogether, which was my initial thought, we'll just ignore it. You will have to do a sale portion and then a credit at the date of refund.
Thank you. And another question here from Janet is, for a close year due to a reassessment, how long can a taxpayer get financing from tax management?
Great. Yeah, that one is really restricted by the legislation. So when we come to reassessments, the reassessment rules say that you've only got 60 days to use tax pooling from the date of that reassessment. So it's really important that when you get a reassessment notice, that you get in touch straight away to get your tax pooling transaction set up. If you're doing a voluntary disclosure, I would often say to people, get a quote before you even file so that you can put in today's date as a sort of, you know, indicator at this point for the reassessment. Make sure that you go and change that later when you get the actual reassessment date, but at least gives your client all the information to say, yes, you've got this reassessment for whatever reason, but we've got a solution for you. We can use tax pooling, but you've only got 60 days to make that payment and get the tax transferred across from that date of reassessment.
Another question is, can I buy tax to fix an ICA debit position? Yeah,
and that was something that I mentioned in the previous session, part of the session there. And the answer is only if you've got a liability for a current year that you can go and buy that tax for. You know, as we said, IRG is not in favour of us using tax pooling for the wrong intent. But if you've got a tax liability, by all means, you can bring forward a payment, pay your P3 at P2 to fix that debit position if you've got a tax liability for that year.
And does it really matter if I record a purchase in a current period of ICA?
Yeah, I mean, that's a lot of people's view. You know, what is the harm in actually recording a credit now? Because at the end of the day, I haven't created a debit balance, so will IRG really have a problem with it? And I guess it's whether they're going to, you know, what the operational policies are, or whether they're going to what they think, you know, is a practical solution. And we're not seeing them auditing people at this point in time. But it is something that they did about, I don't know, about 5 or 6 years ago. I think they did a bit of an audit on ICAs for people using pooling, and we haven't seen them change that practice or hit on people for that practice. Oh,
Perfect. And just following up on one of the questions just before, around the 60 days from a reassessment, an added question is, can a taxpayer get financing from tax pooling beyond the 60 days?
Sorry, that is, yeah, no, you can't. The 60 days is it. The financing in any situation finishes at 75 days for normal tax periods, so you can't go beyond that. And in a reassessment point of view, you can't go beyond the 60 days. So we find that most people will use a flexible product because they've got a very short time period to pay that in. Often they're only coming to us a couple of weeks before that 60 days is up, but you can't finance past that 60-day period because you have to have finished payment and transfer within that 60-day period.
Another question is, a company breached continuity on the 30th of March 2022, whether the imputation credit balance can be sold to tax management, then get an IC refund back after the breaching date.
Yes, that can happen, that you can sell that and then redeposit it, and that can be an effective way to manage that position.
Perfect. Do I need to file an amended ICA if I'm increasing a credit balance?
No, so if you're increasing your credit balance, no, don't go and file an ICA. At that stage, that's sort of that technical part about where you would just send a secure email to IRD through the secure mail and MyIR and do that. The only time you're required to file and that they only want you to file an amended ICA is where you get into a debit balance position.
Can you share any Plexi financing arrangements?
I'm not quite sure what the question is there in terms of sharing it. Are we meaning just go through a description of how one happens?
Yeah, I'm going to assume they're just wanting a bit more information on the Plexi financing arrangement.
Yeah, so when people are doing a flexible financing arrangement where they just want that full flexibility because the client has this, it'll be a period after 60 days, thank you. So if you're doing a normal arrangement, you've still got that time period of 75 days. If you're doing a flexible arrangement, you can go and purchase the tax at any date between now and that 75th day. In terms of that's the date that you're going to say you can pay. What a lot of people will do will say, okay, say I have an upcoming tax payment and I'm managing my cash flow. They might set up an arrangement for that date. So maybe it's the 28th of August coming up, and it'll be a flexible arrangement. And they will put in the date that they will pay that arrangement or start paying that arrangement, should be the case, as on that 28th of August. So they might pay a small amount of that at the 28th of August, or they might pay nothing. And then every month they'll get a reminder from us saying, you know, here's your statement, here's the balance that's due. And as and when they have the cash, they'll make a payment towards that. They can continue to do that up until that our last payment date before the 75th day, at which point the transaction basically has to close. And we usually follow up everyone and say, are you intending to make the final payment on this arrangement or not? So it's very easy to set up. It takes a couple of minutes, and the interest is a floating rate, so it can change during the course of that arrangement. But hopefully that gives you a little bit more information about setting up that arrangement.
Perfect, thank you for that. So we are out of questions. I'm just going to ask one more time if there's any last, I've probably got time for one more question. Please put it in the chat below. A few seconds.
And I guess one of the questions that you had, just to answer that a bit more fully, with the breach of continuity. If they get a refund back, and I think I've sort of missed a point on that when just looking at that, I'm talking about the double debit, and it's a different rule. So basically, if you, I talked about a sale and redeposit, which is another option that you can use there. But basically, if you've got a deposit in the pool, and then you have, which you've recognised the credit, you've then got a shareholding breach, which does the debit. You've now got that tax still sitting as tax to deal with in the pool. It's still there to use, and you decide that you don't need to use it for an idea liability and you want to get a refund out. You would think then, if you did your sale process with ICA, that you'd have to follow the ABC rules, which is true, you do, and that would give you another debit. But you've already had a debit when the shareholder continuity breach happened. So IRD said, yes, you've got two debits, but we're going to give you a compensating credit at the date the refund was issued or the sale happened. So there is a combination of entries: the original credit for the deposit, the debit for the breach of shareholding continuity, a debit for the sale using the ABC rule, and then a credit to counteract that and make sure you don't end up with that debit balance in this particular case, neutralising it at the date of the refund.
There was just a little quick reply to that, was that they understood it was a 49% change, not 66 in the breach of community.
I thought loss continuity was sitting at the 49. I thought that shareholder was at 66. But I'd have to check on that. It's not, I actually deal with the breaches themselves. I don't do the calculations of those breaches. My advice is actually from a tax pooling perspective. So I usually let everyone else work that out, and then I deal with the imputation consequences or tax pooling consequences outside of that. So sorry, Janet, I can't answer that more fully than what I have there.
Perfect. No worries. Well, thank you so much. That answers all of our questions from our attendees today. I'm going to hand it back to you, Linda.
Amazing. A big thank you there to both Kathleen and Kane for a fantastic webinar. Special thanks to everyone for your participation, your questions, as well as for your attendance today. That does formally conclude today's webinar, everyone. If you're ready to leave us now, go ahead and click on the cross on the bottom panel, letting you know upon exiting, you will be automatically redirected to a feedback form. It only takes about 30 seconds to complete. However, it's really beneficial for CPA Australia as well as our panel, so please go ahead and leave us your thoughts. Just also letting you know, everyone will also receive a copy of today's webinar recording. Keep an eye out for it. It will be emailed through to you within 24 hours. Thank you once again. Thank you. Special thanks to Kathleen and Kane. What I might do now is I'll pop on the music as you all exit. Have a great day. Stay safe, everyone. Thank you.
Thanks, everyone. Bye.
Thanks. Bye-bye.
Thank you.